Hey, this is Rod Cleef, and you are listening to the Mailbox Money Show with Bronson Hill.
All right, so multifamily is changing. We've been talking about this for a while, and a lot of things that are changing are just, deals are starting to become available, but yet we haven't seen the distress that we thought we might see. And why is that? It's because lenders have done this extension. They've said, oh, we're just going to extend and pretend that things are okay, that you're going to be able to make this payment. We're going to extend and kind of make it work for you. And we've seen that. We've seen a couple deals that's happened of ours. We've seen that's happened with other folks' deals. And so we're seeing that in the industry. And so Charles is a multifamily operator, just a great guy. Been doing this for quite a number of years. Even comes from a family of multifamily operators. He's got a really interesting perspective on just what's happening right now, where we're headed. He's also done some other just personal investments in the ATM space, kind of like what we do on our active side, as well as other things. And so you think you'll enjoy this conversation about multifamily, about what's happening, about if you're an investor, is it a good time to invest, and what are the opportunities today? So let's jump in. All right, today we've got Charles Carillo. Welcome, Charles. How you doing today?
I'm doing great. Thank you so much for having me on, Bronson.
Oh, excited to see you, man. I know I was on your show a while ago. You've got a great podcast, and you also have very similar to us about 200 million in real estate, mostly multifamily, and you've done some different things both as a and an active investor. And I love talking with multifamily operators these days because there's a lot to talk about. Things have changed a little bit. There have
Yeah.
been challenges. I feel like it's been like a like a movie it's like it starts out real chill and then it becomes a drama and then it kind of resolves. So there's always like the crisis and the opportunity, and there's things that happen both positively and negatively. So talk to us a little bit about give us your background. I know you have 200 million in multifamily. You have Harborside Partners, your company. Talk to us, how did you get started in real estate, and then we'll kind of go from there and kind of jump into some different stuff here.
Yeah, in a quick couple of minutes. So I grew up in a real estate investing family. My dad has been a multifamily investor since 1984, so a few months after I was born. So it was a business that I grew up in, and he self-managed all of his properties. He had a partner, and they were tough properties. They were D class, some C minus there, just to be nice to my dad, but they were very, very tough properties. And so it was you can't really pass those type of properties off the property managers, and my dad wouldn't want to pay them anyway. But it's something that it's you deal with a lot of it's very management intensive. So at some point, I think like in the 90s, before he started selling them off, him and his partner had about 100 units, and they range from like maybe like one or two, three families, but most of them were like 6, 12. So he had 18 unit property. And so they're smaller multifamily, as we would say for syndicators, but they were like larger on that smaller scale. You know what I mean? And very cash flow heavy properties, not so much appreciation. They were in a town about 15 minutes from where we grew up in central Connecticut. So it was that was my initial entrance into learning about multifamily and just kind of like not liking it whatsoever. It was just the issues that my dad had to deal with compared to like issues that I'd hear from my friends' parents have and like their
Yeah.
jobs as like attorneys and stuff. It was a different type of thing.
Did you
So
say like I'm never gonna do this? Like I've never,
yeah.
I just like, oh, I'm never gonna be a, own real estate, whatever, and then laugh like here you are.
It's funny because you don't really put two and two together. And then I think when I was in like it was getting into high school and you start picking up on things that you don't pick up on when you're, younger than that. And it was just like we took long vacations, not like they were most lavish, but they were long vacations. My dad always had ability of time. Time was always he could always work something out. He never missed one sports game. He never missed one like I was in Boy Scouts, I was an Eagle Scout. I never missed one of those things, anything we did like
Wow.
that. So when you put that together with like, when you're at any of these events and you see parents coming in late, stuff like that, and it's, or not coming at all. And you start figuring out that the time is like really, and then the time obviously I think people start with the money as being most important, and I think it switches to time, and that like happened to me too during my whole. You know what I mean? It's like more
Mm.
important about you know, it's like you want to build your business, but you really want to have it as more of like make it so it's more of a lifestyle type business in the sense of, you know what I mean? Where you're able to, I can raise money for certain deals I want to do. If I don't want to do these deals, I don't have to deal with them. I know this deal is going to be very management intensive. I don't want to do it. This one's going to be like a straight double, triple. You know what I mean? It's going to be right down the middle type of play. that's something property I want to deal with. And you're kind of like getting away from stuff that's like, oh man, I've done like one like that. And that's just going to be like, that's going to be management intensive. I'm going to be there all the time. And I think that's more of like when investors get older, I think, and they've been around real estate investing or whatever they're doing. And it's like, that's kind of the route they go to. You know what I mean? And that's how I've done it. And, now my dad, he still has some properties, completely different from before, but it's all, B class properties. And that was one thing he instilled on me. And I bought my first property in '06, and it was a house hack, which they call now. It was back then. I was just living in one unit, renting out the other two, and it was a 3-family.
Sure.
And I did another one in '08, end of '08, completely different from the end of 2006, completely different market. And then I bought my first commercial property in '09 and kind of started from there. And it was a small foreclosed mixed-use building, and then grew that a few more years. And I moved to Florida in 2012, put a property management company in charge of that. And since being down in Florida, I've been really focusing on larger properties and getting involved finally with syndications 2018, something like that.
Okay. So yeah, you've been doing it for a while. You kind of started a little bit on your own, kind of pieced it up and kind of different things. So you've had third party management, but you're very involved in the operations, and these are more in-house properties. So you have partners, but it's mostly people to help support you and things like that and what you're doing. That's great. How's the transition been from going to doing it yourself to the last 5-6 years doing syndication? Has that been interesting, challenging? There's been some good years in there. There's been some years where there's the last couple of years where you said you've been selling a lot, where it's
Yeah.
been a little more. It's just changed a bit the last couple of years, of course.
Yeah. So in from like '06 to 2012, I self-managed my properties for that whole time. And as I got later into those years, I was bringing on more people for helping out and like farming out more roles. And like the first couple of years, I know what I was doing. I did everything myself. And at the end of it, I really figured out, you can, all this stuff can be like outsourced out of your hands. You know what I mean? And that saved a lot of time for what I was doing. And then over the last, for us, since we've been involved with syndications, obviously, you were there too. It was a wild ride. And then I had a property manager that was retiring in Connecticut. And so I sold my whole portfolio. We listed it right around Thanksgiving 2021, right before Christmas. Sold it in the first couple quarters of 2022. Sold a couple properties. I think we had two more properties in Tampa that we sold at that point too. And then we sold another property in just last year. So a lot of selling on the property side of what we did, and really got out of, number one, got rid of all C-class properties because C-class properties were great, we found, through COVID in the markets that we were in. However, as the funds dried up that were really supporting a lot of these tenants, and it didn't dry up until really like the end of 2022, something like this, and in 2021, really, something like this, depending on what markets you were in. And, as those funds really dried up, it really, those properties, you had issues with collections on some of those properties.
Yeah, it's interesting. I'd love to hear your thoughts on this too. For a while, I was very loved Class C, kind of similar to you. Loved it because it there's kind of some margin of safety built in where you have upside on rents. But in reality, a lot of times these C properties, a lot of times the performance can suffer. There's more volatility in the tenants. It's a tougher crowd versus A and B properties. They tend to like perform as expected or even sometimes better. And so has that been your experience as well? Like kind of like on paper, some of these C and D property, oh, they look amazing. And then you look it's like it never works out that way. It's always yeah, that's why it was on paper and not in real thing, like actually in
Yeah.
real life. So
Yeah, no, that's 100% true. Is that I remember when I start looking for properties, and if I brought something or my brother brought something to my father, he would never say no to it in the sense of like, hey, we're looking at buying this. He would just say, hey, that's very management intensive, and that's going to require like daily, like you being on site. You know what I mean? And that was like a way of like, hey, that's like a piece of crap, like a war zone. You know what I mean?
I love that your dad didn't reject, he redirected, right? He's
Yeah.
like, that's a very interesting, but here's what it's going to require. If you like, instead of like saying like, that's the dumbest idea I've heard today or something, like
Yeah.
he didn't say that.
You're not going to be spending your weekends at the shore. Let's just say that. You know what I mean?
Yeah.
You're going to be picking up trash and trying
Yeah.
to like collect rent. So the
If you
thing
wanna
is
do
that,
that,
yeah. So, but I read a stat, and it was like the catalyst that really pushed us over the top for getting rid of all C-class. It's like most C-class renters, I saw it, the stat I saw was they have about $400 in savings. And even if you say that 600, 800, 900, it's still less than what we're really charging a month for rent. You know what I mean?
Yeah.
So it means is that if any shakeup happens, like literally 1 or 2 days out of that 23 days they're working for the month is not how it goes, you're getting rent paid late. You know what I mean?
Yeah.
And then I have to tell my investors they're getting rent paid late because they're not going to delay the car or Netflix or anything like this. It's going to be
Yeah.
Bronson, you know what I mean? Hey, bud, paying the rent late.
I've
And
got till
that's
the 5th of the month, right? And can you maybe extend longer? And COVID's a reason. I can have to pay for a year, right? Depending where you are. In LA, we're still like people saying, "Oh, it's COVID, I can't pay," and crazy. It's crazy.
yeah, yeah. I mean, that just goes to show you where you're investing, where you should be investing. Yeah, it's there's
Mm,
some markets that are very tough, difficult out there. But seeing that fact was something that, and then really getting focused into like what you were saying, B, we don't really get into A on the active side, but B, you're really getting credit tenants. And, credit tenants being people that actually have credit. They actually have jobs where they're going to be making 3x the rent. You know what I mean?
right.
Or more. And they have car loans or leases and they want to buy a house. So these people like care
Yeah.
about their credit. They sign something and they actually
From it.
follow it. You know what I mean? They're
Right.
actually following what they say. And that makes it a lot easier. And so it was something for us personally. Would I buy if I went for a joint venture with someone? Would I buy C class again if it was the right thing? Yes. Would I take passive investor money into it? No.
Right.
Yeah.
Yeah, absolutely. Yeah, it's interesting too in our journey, like kind of how things change over time, how we what we like, and even in different markets. There's certain things now. I mean, for a while, and we can talk to this a bit. With multifamily, it's gotten harder to get deals done because of higher rates, and even stuff too. A lot of people don't want to sell, so it's a lot of times. And we thought, it was about 2 years ago, there were all these people saying, oh, we're going to do this distressed, multifamily fund or whatever. And a lot of people haven't really found the deals because even lenders are kind of extending terms
Yeah.
now. What are you seeing, I guess, you can speak to kind of how that's changed multifamily, I guess, particularly as an operator who's looking for new deals. Like, what are you seeing right now? Have the deals been getting better, or is it still kind of like we're still kind of waiting for things to get better? Like, what are you seeing?
I hate to be on the sidelines. It's just something I always am looking. If we get deals sent to us, we're reviewing them. It's from brokers or from one of our partners. We will review them and we'll see what the feedback is on them and see exactly how it would pencil for us. But there's not been much of that. I mean, over the last we got deal flow in like beginning of 2023 and maybe quarter one, quarter two, and like end of Q2, Q3, Q4, it really slowed down. You know what I mean? People holding off and we're getting stuff here and there, but I mean, it's like we want to be buying. It's really we're bumping that up. I used to say like 1985, 1980 and above. Now you're like 1990. These properties are getting older and cans are getting kicked down the road. And there's going to be some actual bones of the property, right, that are going to need some major work. And with the lenders, what I'm seeing too, and this is something that happened on the residential side, and I was talking to someone about this, is that I had a couple contractors like in 2009, 2010, and they didn't pay their home mortgages. And I remember them bringing the paperwork to me. They brought it to my office and they'd show it like the workout that they had. And they're like, oh, is this a good deal or whatever? And they would owe like, 80,000 on it. And the bank was like, instead of foreclosing on your property, we will give you a 40-year mortgage now, a brand new mortgage for 40 years. Like
Yeah.
it was like the best deal ever. And it was like 350 a month, right? This
Yeah.
person had to pay. And you're like, that is just like a can kicking down the road where they're like, okay, instead of losing like, all this money, you know what I mean, on this mortgage, right? We're just like, kicking it down the road. Hopefully you're going to sell this in like 2 or 3 years because we're at this lows of the market, right?
Yeah.
And instead of us foreclosing it, we'll just like, change this
Yeah.
around and interest rates were dropping then too. So it's a simpler thing, you know what I mean? Because
Right.
everything was like, I remember, got a mortgage 6.5 at the end of 2006, 2008, 5.5, refinance stuff out, 4.25 in 2010. And it was just like, you know what I mean?
Yeah, and some
So
of 2.25% or some crazy rates. And then, I mean, it's interesting with single family because these 30, 40-year mortgages at 2.5%, 3%, people can't sell. And so it's caused, some
yeah.
multifamilies come down. I mean, there's one area of Atlanta we own where the rates are down about 40%, where the
Wow.
valuations are down about 40%. Other areas, maybe 20, 30%, but because of interest rates being higher. But, single family's gone up 2 to 3% over the last, 2 or 3 years. just from interest rates being high and people don't want to sell. So it's interesting. We have like different markets in different things. Where do you think we're headed? I mean, the Fed has said, we're going to drop rates a few times this year. There's a lot of speculation that will happen. What do you think that will do? Will prices of multifamily start to go up again as rates come down? Because even when they announced that, now interest rates are down almost a full percentage point or about there. So
Yeah.
where do you foresee us heading for that?
It changes everything because we're in the election year. You know what I mean?
Right.
And it doesn't matter the party that runs it or not. It's usually the election year is, I mean, to get reelection, I mean, that's where you might see rates coming down that really shouldn't be coming down from where we are. You know what I mean? It's just that usually rates are coming down when there's an issue. Like we were just saying that 6.5 to 4.25 over those 4 years. I mean, that's something that just shows that we are going through such a major issues. And to get money out of
Yeah.
people's pockets to have people buy, they were dropping rates. And that makes sense. You know what I mean?
Yeah.
I was reading a chart the other day and it was like, we'd be like 8 months in if they dropped it like in March, right? And usually it's around like 8 to 18 months. You know what I mean?
Yeah.
From where, when it starts being cut again. So I don't know. I mean, I would think if it wasn't a presidential year, I mean, there might be some, but I mean, I think if people think that the rate cut is going to save their deal, I think that's the wrong way to
Yeah.
be thinking it. They should be doing they should be doing the workouts with their lender because the lender, going back to the residential example, I mean, I think you're going to see less than ideal properties, right? Properties that we probably don't want to buy coming back on because the banks probably will cut their, lenders will probably, cut their losses there. But
Yeah.
I mean, we do have over $1 trillion worth of maturities coming from 2024 to 2028. And about, you have more than half of that is by government sponsored entities, which is Freddie and Fannie. And then you have just under that, you probably have you have a little less than half that is going to be in banks. You know what I mean?
Yeah.
So it just shows you where these maturities are coming up and when those do come up, because even if somebody got fixed, we have one deal that's like 4.96 fixed and bought in 2021
Hmm.
and it goes to like January 1st 2029. But the thing that was that if interest rates haven't come down by the time for that's like one of the loans, the other one comes up in like 2027. I mean, the cap rate's going to be, still going to be pushed up there, on the
Yeah.
sale. So it's like, and
Right.
that's something obviously no one can foresee what a cap rate's going to be in 8, 9 years, even interest rates, obviously, especially
Right.
after what just happened. I mean, over the last 2 years, you know what I mean? It's just been
Yeah.
insane. But
I look at the we do a lot of alternative assets too. I know you do. I wanted to get into that in a little bit too, but we're looking at, this is the Mailbox Money Show. So it's how can we generate cash flow? And I look at appreciation and cash flow and think cash flow is what allows you to leave your job or what allows you to retire or pay for expenses or things like that. And but there are just so many assets out there that are doing things. And it just feels like there's pieces on a board, like it's like a board game. You're playing chess, and yet the pieces are kind of getting moved around continually. And so it's kind of a new board every time you look at it. So, what are some things, I guess, beyond multifamily and just in general, for a passive investor that they should be considering right now when it comes to investing in their wealth and just kind of some opportunities that, may or may not be out there? Just what are some things you think people should be aware of?
yeah, so if anybody is a passive investor in any real estate investments, especially like multifamily or any commercial real estate, you're definitely seeing you're seeing distributions halved, you're seeing them stopped, whatever it is, you know what I mean? Depending on the project. And we're getting some of that too. We haven't gone into any capital calls or anything like that. We don't have any problem assets that are in that area. But what we've seen, like on my passive investing side, I am an LP and a number of times in ATM funds. And that's something that's like we were talking about this before, and very strong cash flow, very consistent. And it's something in an actual growing industry. Maybe I think the disconnect is that people investing into it don't use the product they're investing into.
Yeah.
And so it makes it a little different. But also, I mean, when we buy, C-class properties, when we did, or B-class properties, I mean, how many people are really living in that are investing in it? So it's a different
Yeah.
mindset you have, but I think that's a class that's growing. And I definitely don't see that going away because that is an unbanked, and it's difficult for people to walk off the street that don't have a lot of money to go into a bank to access. That's why we're having all these online banks come around. You know what I mean?
Yeah.
That are doing all this to get business, and hopefully they can lend you money, but it's still something where a lot of people aren't using credit. You know what I mean?
Yeah.
In that sense, maybe they got burnt with it before and they don't even use a debit card. They do everything in cash. I had a contractor years back and I would help him get bank accounts. And he became like a friend. I was helping him with stuff and he never could handle the bank account thing. You know what I mean?
Yeah.
Like give him a check, and it was like, I'm like, hey man, I gotta pay, like property manager pays you in a check. You know what I mean?
Yeah.
Like you're gonna do work for me, they get paid in a check. And it was always like he did good work, but it was something that it was like, I mean, that's how it works on that. You know what I mean? You know what I
Yeah.
mean?
Yeah,
So
totally.
people have issues with banks, and that's a growing asset class that we've seen. That's been very cash flow positive on my passive side.
Yeah, and we do ATMs funds as well. I think it's a similar operator, and so it's been a great experience. Actually, it's been the most consistent cash flowing deal that I've seen, which I love. And then, like I've said, it's the hardest part is convincing people that don't use ATMs that there's this 10% of the population that is unbanked that operates in cash and prepaid debit cards and things like that. And so it's just very interesting. Yeah, are there any other assets that you like personally that you're invested in or that you look at or that you kind of are like, oh, this is something that I think could be an opportunity, either for you or just for people to consider?
I wouldn't say this is a cash flow asset by any means, but I do my brother and I, we do passive invest into early stage companies like angel funds, stuff like that. And we've done that over the last few years, and it's very interesting. You get into a lot of different companies. It's definitely not a cash flow play, and it's definitely something where you should be, it's like, a very small percent of your net worth should be going into these, but it is something that it's similar to syndications. I've done them one off before by working through a syndicate, like a group, just like we would with a sponsor. And then I've done funds before through that sponsor as well, which gives you a little bit more diversification. And but what I found there is large funds, they don't have best returns. It's really when you're getting into smaller funds, maybe 10, $15 million. These funds, that's where they can really outperform. And that's where you're getting the returns. But it's much different from real estate in the sense of it's very risky, but it's also something that you're not just looking for. Like if we get a 2x in real estate, it's like the best thing ever, right? You know what I mean?
Yeah,
Like it,
right.
and even if you're getting like 1.8, 1.7x, I mean it's
Yep.
fantastic. And then, but with this, it's like you put money, people aren't happy if they're not getting 4x, right? Because of like but it's over so many years, you don't know what's happening. You definitely don't have any control, just like you would kind of in the past. But at least I know if even if I have a property and I'm not getting paid distributions on that property, I can look at it, I see financials, and I know that okay, we're still cash flowing. You know what I mean? Like this
Yeah.
property is still making money. They're like saving up to buy another cap or whatever we're doing, or to like pad it so when we refinance. But like you don't really see that on it, and you're just like you get updates on it, and they're very simple. You're getting updates from a company with like 4, 5, some people, 15 people in it. You know what I mean? Very small
Yeah.
companies. So it's a very interesting asset class that I've into, but it's not a cash flowing asset. The best one I've seen like you has been ATMs over the years. And
Yeah.
so it's been like 4 years, I think I've been investing in those.
Yeah.
And it's very cash flow positive, and it is difficult. I mean, people ask me about it. I'm like, all right, you just got to do your own research. But like, this is what I found in it. And obviously you've done a lot more research because I've only done it on the passive side. I haven't done it
Right.
with other people's money. So I haven't, I guess, done as much due diligence as you have, which is great.
Yeah, and it's interesting, as I've noticed that a lot of my real estate investments, a lot of them are cash flowing very well, and then like you were talking about, that it's changed a little bit to be. I still think it's some of the cash flow has gone away or it's gotten reduced, so there's been some issues, but I think it's just a weird time where interest costs or even expenses or labor or all these things are just going up, and it's hard to like sometimes explain to investors that aren't as sophisticated to like, hey, here's what's actually happening right now. Like it's
Yep.
we're doing the best we can, but it's kind of a interesting time. And of course, those seasons don't last that long. And I think we'll look
Yep.
back on this season and think, man, I wish I had bought a ton right now because interest rates are higher, whatever. What's going to happen? Interest rates come down. Well, of course, asset prices hopefully should go up, and we don't know.
Yep.
But cash flow is nice. So one other thing we've done is oil and gas, which has been nice for cash flow as well. Certain types of doing wildcat drilling is a little more risky, and we're not really doing that. But there's other things that it's just amazing. Whatever you're looking for, whether it's tax breaks or it's cash flow or appreciation or retirement account. There's different things you can do that are out there, which I think is really good.
Yep.
What are you, I guess, in your business? What are you most excited about for 2024?
I'd like to see exactly if we're getting deals that come back on. I mean, like with a lot of workouts, like you were saying, you know what I mean? And keep, everybody's telling me that there's going to be all these deals coming up, and I've been told this for so
Yeah,
many years from people. And I'm like, I just don't see. I mean,
it's
if
not
you're,
happening.
yeah, I mean, maybe if you're going to sell me some like some 10 unit in the ghetto or something. You know what I mean? But like,
Yeah.
no one wants that crap. That's why it's going
Yeah.
back on the market to be sold for 50 cents on the dollar, 25
Right.
cents on the dollar. But
No one wants it.
it's like what we actually really want to buy. Everybody wants that. And there's
Yeah.
apparently there's so much money on the sidelines. I'm told this too. So it's like, I guess the rate cut comes and everybody puts money into the stock market. I don't know. You know what I mean? But
Yeah.
it's like, even if the interest rates come down, we've had these other things that like change. First of all, very difficult to find good people. And, you know, what you're paying $35 an hour for someone to be on site now, at least depending on the market you're in, you know what I mean? To $40 an hour for handymen on site, you
Yeah.
know? I mean, it's extremely hard to find good people on site. Insurance costs, no matter where you're investing, that's coming up. And then you have taxes. And you have a lot of these locales that have been increasing property taxes as these properties have increased. And I mean, these are things that aren't going to be changed with interest rates. You know what I mean? Per se. You know what I mean?
Yeah.
It's just like, even if interest rates come down, and people say, oh, you know, or the value of your property might have went down, you know, so you can get property taxes down. But all this stuff, I mean, all these things, these costs still went up and they're not going to come down with interest rates. So it's something
Yeah.
that once we hopefully see, I would just like to see rent increases. And we're starting to see it, especially in like markets. I was reading something on Real Page and you start seeing, you know, Tampa's at 3.9, they say for this year coming up, and some other ones
Yeah.
where we're invested in too. So I still see it coming and it's going to start again. I just think last year was just, you know, we just had, it was pretty stagnant on rent increases and has to start up again. I mean, to cover these expenses that are really coming up for operators. You know what I mean?
Yeah, no, it's true. I mean, there's been this a couple different. You brought up a lot of things like the money on the sidelines. There's like $6 trillion on the sidelines of people waiting. Like I said, there's multifamily funds that are like distress funds, whatever. But we're seeing most lenders, the things I've heard about or seen, you know, a couple of deals we've had that have struggled. Like lenders are extending terms. Like there's kind of the extend and pretend. Like, hey, well, what can you afford? Kind of thing. It's just kind of make it work. And because they realize, you know, like in 2008 what happened is they don't want to take over properties that, you know, lender, whatever they tell you, they do not want it. So if you're, you know, you're managing at 80, 90% or whatever doing, like they're going to be like, hey, let's just try to work this out rather than because they know like this is a really challenging time for everybody. And so I think if lenders do foreclose, it can be really disastrous for them as well, because then they'll end up with a 60% occupied place, have to do a fire sale, and they don't want to do that. They just want to figure, hey, how can we,
Yeah.
you know, and think it's the same kind of what folks are doing with multifamily operations. Well, Charles, I really appreciate you coming on today. I know you're always adding value to the conversation. You've got a great podcast. Can you share the name of your podcast as well as how can people get in touch with you and follow what you're doing?
Yeah, thank you so much. So a podcast is called the Global Investors Podcast, and if people are interested in that, they can find a link. Just go into any podcast platform. My company is Harborside Partners, so you can find all the information at harborsidepartners.com. And if you go to harborsidepartners.com, the podcast, I have a YouTube channel. I do interview based like this, where I had Bronson on, and then I also do another podcast on Saturday called Strategy Saturday, which is a very short form where we just work through one strategy or something that's happening in our business, something that we're working through, or something that I've realized over the years, and I'd like to share it with people. So that's the best ways of getting in touch with us.
Awesome, brother. Well, appreciate you being here today. We'll have to connect again soon. And thanks so much for coming on the show.
Thanks a lot.
All right, Charles Carillo, good guy. He really knows what he's talking about. And again, I think for you as an investor, it's just so important that you pay attention to what's happening in different industries. And we pay attention to a lot of things, right? We're paying attention to the macro, which is kind of the higher level. This is what's happening in the economy. This is what's happening with the Fed. They're lowering rates. And then what impact does that have at the next tier down? What happens in real estate? What happens in businesses? What happens in ATM machines or car washes or oil and gas? And just be thinking through those implications when it comes to your portfolio or even your goals. Even if you're looking to invest, you know, rates are projected now to come down. Well, how is that going to affect the things that you're invested in or the things you're getting involved in? So those are all factors that are important to consider. If you haven't joined our investment club, I highly encourage you to join our club. We have some just really amazing things that are coming out or have recently come out that we're really excited about, and you really can't find them anywhere else. So check it out at bronsonequity.com and click the join button. We'll start a relationship with you and set up a call and get to know some of your investment goals and see if it makes sense to work together. So thanks for taking the time to educate yourself. We'll look forward to seeing you on the next episode of the Mailbox Money Show. You've been listening to the Mailbox Money Podcast. For more free resources, articles, and videos, go to bronsonequity.com. There you can download your copy of the special report, The Single Best Investment Strategy During and After a Pandemic. None of the information shared here is an offer to buy a specific investment, and this is for educational purposes only. Consult your financial, legal, and tax professionals and use your own common sense before making any investment decisions. Thanks for joining us, and be sure to tune in next time for more Mailbox Money.